In today's video, I'm going to explain to you why the P/E ratio is one of the most overused metric tools when analysing a stock price. Given the P/E ratio is a guide based on the previous 12-month earnings, on paper, this ratio should be flat in theory. But as we all know, markets are not so straightforward, as there are many fundamental and psychological factors that impact the market and the valuation people put on the market, such as market cycles, investor sentiment, and other various psychological factors. Investors typically hold the perception that the median fair price value for a company based on its P/E ratio is between the 10 and 20 range, with anything over 20 being overvalued and anything under 10 being undervalued. For example, if company X's valuation is 9 million and their net income for the prior 12 months is 1 million, then the company's P/E ratio of 9 would be undervalued. What potential shareholders here are looking for is an inefficiency in the market. Just like many other metrics, the P/E ratio provides us with a partial story of the business's current valuation. In order to make a more informed decision, we need more information. One important consideration we have not taken into account, which we certainly need to consider, is the business's ability to grow and whether this business is growing or declining. In an ever-changing world where the demand for a business's goods is constantly fluctuating, the P/E ratio becomes a flawed metric. If company X's valuation of $9 million earns $1 million in the prior 12 months earnings, based on the P/E ratio of 9, this business would be considered undervalued. But now consider that this business is declining at 20% per year. In 4 years, that $9 million business will have a P/E ratio of 45, which in the eyes of the P/E ratio would be classified as considerably overvalued. So how do we account for growth or decline? There are many ways to do this, but one of my favourite metrics is to use the PEG ratio. Famously used by Peter Lynch, the PEG ratio, shortened for price, earnings and growth ratio, is a metric that combines the P/E ratio with the company's expected earnings growth percentage rate. The PEG ratio provides a more holistic overview of the business's valuation than the P/E ratio alone, because it does take into account the company's expected future growth. A PEG ratio below 1 indicates that the stock is undervalued and may suggest the company's growth prospects are not fully reflected in its stock price. A PEG ratio above 1 might suggest that the stock is overvalued and investors are paying a premium for the company's growth. Going back to our example of company X's valuation being $9 million and the company's prior 12-month annual earnings being $1 million, if this company was growing at 1%, the PEG ratio of this business would be 900. Why 900, you might ask? Well, if company X's P/E ratio of 9 minus the earnings per share of 1 is divided by the future growth of 1%, then that comes to a PEG ratio of 900. Given that anything over 1 is considered expensive, if a company had a PEG ratio of 900, this would be considered extraordinarily expensive. Notice how when growth is considered, the outlook on the company's valuation completely changes. Although it is nice to know how this calculation works, there are many platforms that update this PEG ratio every quarter, such as Seeking Alpha. If you would like to learn more about Seeking Alpha, I've put some links below where you can go check out their website. And if you are interested in signing up for a subscription to Seeking Alpha, there is also a link down there where you can receive a discount in your first year. I hope this explanation was useful for you, and if you are still currently using the P/E ratio, maybe you will consider its importance in the near future. Ultimately, I'm not a financial advisor, so you are required to make your own decisions. If you would like to leave a comment section down below with any questions you may have, or maybe there's a topic you would like me to discuss about, feel free to let me know, and I'll see if I can make a video explaining this a little bit further. Until then, see you in the next one, and thank you for watching.